Thank you for attending our webinar. My name is Travis, and this is Jack. Today, we're going to spend about 20 to 25 minutes just having a discussion on current and also some historical market volatility that we've been seeing. Before we get into the workshop, at the bottom of your screen, you can probably see a chat function. The purpose of that will be for you to ask questions, and just to respect everyone's time, what we'll do is we'll try and get through the content first, and then Jack and I will spend some time after the workshop answering as many questions as we can. Okay, so Jack, you're in the hot seat first. So over the last 6 months, we've seen quite a strong pullback in equity markets. And I think one of the biggest questions in individuals' minds is, what's your opinion on what you're seeing out in the markets right now?
Okay, so I guess we'll probably should leave a disclosure at the end, but this is our opinions, and we're working on things we're reading and hearing, and also on some historical information. So we want to provide that for you today. So we've got a chart here of the S&P 500, which is the 500 large U.S. listed companies, just the behavior of the index over the last 10 years. And we're going to try and put this in context with what's going on right now. So what I'd like to do maybe is sort of first go back to 2008, 2009, the Great Recession, the financial crisis, and central bankers around the world lowered interest rates to zero, and they've basically been zero ever since. And they lower interest rates to help stimulate coming out of recession. So 2008, 2009, the economy went into recession. They wanted to encourage economic growth, and so they lowered interest rates. You fast forward to 2020, March 2020, we have the COVID pandemic starting. And markets obviously fall quite quickly. They fell about 34% in a matter of just a few weeks. No one knew how bad the virus was going to be, how sick people were going to be, what was going to cause, what economic damage it was going to do. So governments around the world said, hey, everyone needs to stay home, can't travel, you can't go to restaurants. And the concern was there'd be massive unemployment, there'd be a huge number of people out of work. So governments created stimulus programs to help people weather the storm by staying home. President Joe Biden in 2021 gets elected, and he jumps in the ring as well. He wants to be seen doing something, so he sends out more money, and their $1,400 check to everybody back in early 2021. But what happened is unfortunately, technology, Zoom, and so forth. Most people were able to work from home. There were some people who lost their jobs, but there were government benefits to help them get through that. In the States especially, there was a lot of money being thrown around, and people ended up just spending it. So they were buying items. But what happens when everyone thinks you're going into recession, which are technically in 2020 we got into recession, it was very short. So car companies, for instance, they go out there and they phone up all their suppliers and say, hey, stop. We're not going to be making many cars, no one's going to be buying them, so stop manufacturing. Well, turns out people are stuck at home. What do they want to do? They want to buy stuff. They can't go anywhere, so they're buying TVs and so forth. And it turns out actually they wanted to buy cars. And so car manufacturers turn around and said to their suppliers, hey, we're okay, but there's a lot of computer chips go in the cars right now. And so those are actually being used by companies making TVs for those who are upgrading their TVs at home, sort of thing. So that was the beginning of supply chain crunch, and that's a big part of what's going on right now. So, we've got vaccinated. People in the Western world have been vaccinated. We're now looking at traveling. We've been buying things. Central bankers were, looked at inflation. Central bankers are very concerned with inflation. So you go back to the 70s, most of us on the call, except for somebody beside me, will remember the 70s inflation and how things change in price. I mean, my first memory of inflation was a candy bar going from a dime to 25 cents, and then never, sugar prices went up and they never came back down again. But so central bankers were very concerned about inflation. It was very hard on the economy in the 70s. The 70s where it was basically markets didn't move anywhere. It was a long, prolonged recession. There were wage spirals and so forth. So central bankers don't want investors perceiving that inflation will be prolonged, and so they will raise interest rates to combat that. Now, over the last couple of years, they haven't done that because they thought much of the inflation was supply chain related, and it would dissipate once economies opened up and we would just get through it. Unfortunately, what happened, of course, is we get another wave of COVID and gets into China this time on a large scale basis, and they shut everything down. So all of a sudden, all the manufacturers are shut down, so they can't make anything. And that's what's really led us to today. So now they're trying to raise interest rates. We expect interest rates will probably rise. So we see mortgages back in that 5 to 6% range. Back in the early 2000s, when mortgages dropped to 5 or 6%, people were ecstatic how cheap it was to renew. Now we just have a perception of things being lower, and so we're having to adjust to it. Of course, obviously, recently we've also had the Russian invasion of Ukraine, so that's causing energy issues for Europe, causing agricultural issues, and that's added to the inflation. So interest rates are starting to rise, and what has really happened since the end of the year is we are seeing a lot of the large alternative investors, call them hedge funds. They've got programs, and they say when A happens, we do B, and so they're seeing interest rates go up. They say we're going to sell our growth companies, and we're going to buy utilities, for instance, very conservative. We're hearing some anecdotal evidence that, or stories, rumors that there are a couple of hedge funds in trouble. They borrowed a bunch of money. There's things they own they can't sell, so they're selling things like Microsoft and Royal Bank and CP, whatever, large blue chip companies. So it's really a situation of babies being thrown out along with the bathwater. So that's sort of the context of it. So we've dropped. This is a few days ago, about 24%. We had a very strong rise off of 2020. So this period here is a bear market, a bull market. When you rise, long steady rise, it's called a bull market. When markets drop over 20%, it's called a bear market. And Travis talked a bit more about that. But so after the strong growth in the last couple of years, we're expecting a pullback. Now you throw in the Russian war, you throw in larger than expected interest rates rising out of the U.S. Fed, it's causing a bunch of fear and some pullbacks. But we're still seeing the consumer spend money. They're now, people are traveling. Some friends of mine, they had to go traveling. Normally they would drive. They had a very short period of time. They thought they'd put their dogs in a kennel. Couldn't get any space in the kennel. It was booked. So people are traveling. They're going to concerts. They're going to hockey games or whatever. And so it's going to be a switch from buying items, goods, to buying experiences. Companies are still profitable. They're still announcing growth. And today on Reuters, I saw an article about durable goods. So these are manufactured items that last more than 3 years, like airplanes, equipment, that sort of stuff. And the sales are up. Again, in May over April, we're actually seeing increasing earnings or increasing sales. And prices, of course, are going up as well a bit. Companies are still profitable. So we don't see a recession at this point. In 2015, 2016, we had two double sort of drops 10, 11, 12%. Back to back, we thought we were going to head in recession there, but it didn't happen. 2018, again, a fairly quick, short drop, 20% almost, not quite. And then we came back again. What happens when we don't go into recession? We get a bear market. Once it goes past a 20% drop, on average, about 6 weeks later, markets have bottomed and started to move up again. So that's sort of where we're seeing things right now. Inflation, a lot of the inflation, as I mentioned, is being driven by external factors, and that will end. We'll get through that. So on this chart, you can see, so the big takeaway from here is over the last 10 years, it's moved up. And what happens is markets get ahead of themselves, and then they get too far behind. And I'll touch on that later on. Travis, maybe you can give us a bit of perspective on what happens year in, year out, and how markets behave, and sort of conceptually look at longer trends.
So for individuals who read our newsletter, this is a chart that we've put in probably at least once that I can think of. But this kind of highlights Jack's point to some of the volatility that we can see. And so what this chart does is two things. The blue bars represent the year-end return of the S&P 500 index. And when I look at this, one of the first things I noticed is that there are a lot of years where it's positive. However, in some cases, it's how we got there. And when we look at the red dots represent the lowest part of time within that year that the market was down. And every single year, there was a downward part. And you can see, even in years where there's double-digit returns, in some cases, markets were down 10 or 15% at some point in time. And so to expand on what Jack was talking about in terms of a bull and bear market, what we wanted to highlight here is if we categorize the markets into two buckets: a bull market, which is everything shown here in blue, which again is just an extended period of time when markets rise, and a bear market, which is everything shown here in orange, which would be the opposite, just with the caveat that markets have to fall at least 20%. Bear markets have happened. This chart goes back to 1942, so that's 80 years. But bear markets are temporary. And so when we consolidate all the information on this chart and kind of just look at the raw data, over time, about 70% of the time will be in a bull market, and about 30% of the time will be in a bear market. So if we use that data, but in a different context, and say, well, if you were to go to Vegas, go to a casino, and you knew of a slot machine that 7 out of every 10 times you pulled it, you were going to win, you would never stop pulling that machine, even if the first 5 or 10 pulls were negative, because you knew that over time, things would come back. And this is another really interesting chart. And this just kind of summarizes the volatility. On the left side here, this just represents the range of returns that you can have within particular indexes within 1 year, all the way out to 30. And so what you can see, obviously, in year one, or in periods when it's only 12 months, you can have huge ranges. And I think the best example is if you compare last year where we had really strong returns, to this year, where we're seeing a fairly strong pullback. But I think what's important, and most likely what you've heard from either myself or Jack, is when you're investing in the stock market, you have to have a longer term focus. And so what you can see is as you go out in time, so 10, 20, and 30 years, the range of returns consolidates, and investors are rewarded by keeping their money in the market for extended periods of time. So, Jack, as we can see in this year one chart, there are some fairly big ranges of variability in terms of returns that investors can get. In your experience, how do they tend to react, irrespective of whether it's positive or negative?
And that's really, something we all need to be aware of is how people react to things. As people, we tend to think very linear. We'll look at something more or less it's a straight line. And so I'm going to use Bitcoin as a bit of an example here. We don't think Bitcoin's an investment, but it's just going to give you an idea of how people can react. So, Bitcoin goes through these massive swings, and it goes up. It hit $60,000 US a coin last year, and then dropped right down. And what happens on the way up is everyone's saying, "Oh my gosh, look at this! I can make so much money," and they jump in, thinking it's going to continue forever. And then the same thing happens when markets pull back and you think, "Oh my gosh, it's going to continue forever. It's going to go to zero." Well, it doesn't work that way. I think of it sort of as a pendulum. It always swings too far one way, and then it swings back the other way, and probably too far. But over time, fundamentals will reestablish themselves. So usually when people are the most fearful, it's actually the best time to get into the markets. Now, many people on this call are retired, so it's they think, well, I've got no more money to put in, but markets do recover, and that's sort of what we've been talking about with the bull bear comparison and just showing the S&P 500 chart, and the fact that every year we know on average we have 10% pullback in the market. So okay, yeah, we're over 20%. We don't think we're in recession, so if we're not, it recovers fairly quickly from here. But emotions drive the market, and so you can think of Bre-X, where we wanted to get in it because it was going up in value. There's all kinds of examples where it's been driven more by emotions, and then eventually what does happen is the fundamentals come back to bear. And so in our last newsletter, we put this in, and this is Microsoft, so I'm not going to try and hide it. Now, their fiscal year end is in March. So March 30th is their fiscal year end. And so March 30th, their share price was $269 a share. End of December, it was $340. When we did this chart up, it was $242. Well, as of today, it's $265. So it's come back a little bit. But I wanted to really highlight what happens with well-run companies. And this is the fundamental that comes back into things. So in 2007, they had $51 billion in revenue. Their profit was about $14 billion, and they were paying 40 cents a share. And you could have bought a share for 22 bucks. Over time, they have grown their earnings. So as of last year, their revenue, their sales was 170 billion, and their profit was a little over 60. Now there are years where their income does drop, and then the revenue sales drop, and the revenues have dropped, and obviously in the 2008, 2009. So this is the financial recession, the Great Recession. So yes, share prices did drop. They kept their dividend the same throughout until they're sure the economy was recovering. But the big point you make here is, yeah, there's going to be little hiccups in the road, but they're well-run companies. They're going to continue to grow. So that, you know, 3 times their sales increased by 3 times and their income by over 4. Dividends have increased almost every year, and this year it'll be $2.42. If you add up all these dividends through the end of this year, it almost buy 1 share back at the beginning. Now you can say, okay, yeah, the share price has gone up more than their sales, their income. True. What they've actually in this case done is they've also bought back a lot of their shares. So there's fewer shares in existence today than there were in 2007. So that's one of the ways companies will help increase tax efficiently the return to their investors. Okay, so that's the fundamental. This will eventually reassert itself as people look around and say, hey, you know, wow, Microsoft's pretty cheap. World Bank's pretty cheap. Whatever it is, they'll go out and start buying it. Okay, so you know, that you might be saying, well, that's great if you're young, we don't really care about pullbacks. Well, what happens, Travis, if we are, you know, you're retired? You know, what do we do to help clients weather this when they're retired?
Yeah, good question. So for the purposes of this example, just to keep it simple, we've created 2 buckets to put our clients in. Individuals that are accumulating, so for all intensive purposes, people that are working and saving into their portfolio, versus individuals that are withdrawing money because they're retired. The biggest difference between these portfolios, or what we try and do, at least with our clients that are retired, is what we introduce what we call a cash wedge. And depending on the client's circumstance, cash wedges can be anywhere from 6 to 12 months of income. And the purpose is that, as we've highlighted on the previous charts, where over short periods of time we can see wide ranges of variability in market returns, what we want to do is put individuals in a position where they have certainty of the cash that they're going to require in the short term. And really what this does is highlighted kind of in the time that we're in right now. And when equity markets are down, the last thing that an individual would want to do is sell that equity to come up with their cash to then pay their retirement income, because now they're going to have to sell more shares or units to come up with that same cash amount. And so by having this cash wedge, it will help eliminate putting individuals in a position where they're forced to sell their equity in a time that may not necessarily be all that favorable. And so we feel that by doing this over time, it'll help increase the longevity of the portfolio.